we will cover topics and terms that relate to the ethics section of the NMLS test. The ethics section makes up 18% of the exam. This video will cover the basics of the ethics section and will not provide all necessary information for this section or even the topics covered. Ethics. Ethics is moral principles that govern a person's behavior or conduct. Morality. Morality is principles concerning the distinction between right and wrong or good and bad behavior. Redlining. Redlining is an unethical practice where a financial institution makes it extremely difficult or impossible for residents of a particular neighborhood to borrow money, gain approval for a mortgage, take out insurance, or gain access to other financial services because of a history of high default rates. Redlining typically occurs in poor inner-city neighborhoods. In the case of redlining, an individual's qualifications and creditworthiness are not considered. Referral. A referral includes any oral or written action directed to a person which has the effect of affirmatively influencing the selection by any person of a provider of a settlement service or business incident to or part of a settlement service when such person will pay for such settlement service or pay a charge attributable in whole or in part such settlement service. Coercion. Coercion is defined as the practice of persuading someone to do something by using force or threats. Unfair act or practice. Dodd-Frank defines an unfair act or practice as something that causes or is likely to cause substantial injury to consumers, an injury which is not reasonably avoidable by consumers, or an injury which is not outweighed by countervailing benefits to the consumers or competition. Substantial injury. A substantial injury typically takes the form of monetary harm, like fees or costs paid by the borrowers because of the unfair act or practice. Deceptive act or practice. Dodd-Frank prohibits conduct that constitutes a deceptive act or practice. An act or practice is considered deceptive when the act or practice misleads or is likely to mislead the consumer's interpretation is reasonable under the circumstances, or the misleading act or practice is material. Abusive act or practice. Dodd-Frank further prohibits conduct that constitutes an abusive act or practice. An act or practice is abusive when the act materially interferes with the ability of a consumer to understand a term or condition of a consumer financial product or service, or the act takes unreasonable advantage of the following: a consumer's lack of understanding of the material risks, costs, or conditions of the product or service, a consumer's inability to protect his or her interests in selecting or using a consumer financial product or service, or a consumer's reasonable reliance on a covered person to act in his or her interest. Predatory lending. Unscrupulous actions carried out by a lender to entice, induce, and or assist a borrower in taking a mortgage that carries high fees, a high interest rate, strips the borrower of equity, or places the borrower in a lower credit-rated loan to the benefit of the lender. Steering. Steering occurs when an MLO, who has the upper hand and knowledge of the industry, steers a borrower into a loan they think is best. Steering becomes a problem when an MLO steers a borrower into a loan that could potentially harm them for the sole purpose of obtaining a higher commission. Straw buyers. Straw buyers are loan applicants used by fraud perpetrators to obtain mortgages and are used to disguise the true buyer or the true nature of the transaction. Air loan. An air loan is exactly what you might think it is: a loan that has a straw or non-existent buyer or a non-existent property. Disparate treatment. Disparate treatment is either over-discrimination or there is comparative evidence of discrimination. Comparative evidence. Comparative evidence is the treatment of a credit applicant differently based on one of the prohibited bases, differences in treatment that are not fully explained by legitimate, non-discriminatory factors, and does not require any evidence that the treatment was motivated or prejudiced, or that the creditor intended to discriminate against a person. Disparate impact. Disparate impact occurs when a facially neutral policy or practice is applied equally to all applicants, but the policy or practice disproportionately excludes or burdens certain groups of people on a prohibited basis.